how variances can change over time in a predictable way, I and a lot of other economists were sort of astounded that you could do that. And Rob's insights turned out to be the key breakthrough to turn risk management into something you could scientifically measure and analyze. He literally created the field. He over his productive career, he continued to push the frontiers forward, developing tools that today can analyze thousands of different variables, how they interact, and how those relations change every day. He started his career teaching at MIT, and UCSD was fortunate early on in his career to induce him to come to San Diego. And this is where he developed the key insights into arch and co-integration, for which he was awarded the Nobel Prize in Economics in 2003. He basically built the UCSD Economics Department into the leading world institution that it is today. Among the many things he did, he actually started this Roundtable series years ago as a way to try to bridge what goes on here in the academic side with what's happening in the broader community and world. I think great contribution, and so glad that he's here to continue that now. He then went on to teach at New York University. He's currently co-director of the NYU Stern Volatility Laboratory, which provides real-time measurement, modeling, and forecasting of financial volatility, correlations, and risk for a wide spectrum of assets. I think he's going to tell us a little about some of the resources available through VLab. So please join me in welcoming Rob Engle.
Well, thank you, Jim. I guess I'll wait for the microphone.
You stand the microphone on.
Yeah, thank you, Jim. It's great to be here. I mean, I still love UCSD. We live here half the year, and this is part of it now. What I'd like to talk to you about today is work that we're doing at the Volatility and Risk Institute at NYU, which is focused on risk. We're measuring risk in lots of different ways and different dimensions, and this is an outgrowth really of the Nobel Prizes, as Jim just described. So there we go. So one of the new ways in which risk appears to us is climate change risk. And we've been doing a lot of work with climate change risk. We have a lot of features published on the website that Jim just mentioned, the VLab. And so I'm going to talk about sort of a new, relatively new, well, I think it's a new insight that helps us understand the kind of current events we're seeing in the market for fossil energy and in renewable products. So I'm going to start off with sort of a big picture idea about risk. Then we'll go to talk about climate change, and then we'll talk about current events at the end. So I've given it the title here, Have Capital Markets Forgotten About Sustainability? And maybe you wonder whether capital markets ever thought about sustainability in the first place. But this is just a title. It's not going to presume that. And you will see by the outline of this slide that this is a presentation that I'm going to give in Italy. Is it tomorrow? I'm leaving this afternoon, and I'm speaking on Sunday, so I guess it's the day after tomorrow. And so this is a chance to try this new presentation, and I'm looking forward to feedback. Sorry, what do I do? Oh, there, okay. So let me just say a few things about risk. what is a risk? A risk is a bad event that might happen in the future. And what we use to characterize risk is how bad is the event and how likely is it? And once we've got those parameters, we want to figure out how to manage it. How do you manage risk? Well, one thing you might do is not take it. Another thing you might do is try to reduce its likelihood or reduce its impact. And since any of these mitigating policies can be costly, we are facing the famous risk return trade off that's really everywhere in finance. So is this what I need to do down here? Okay. When these risks are far in the future, we call them long run risks. And as we try to manage these long run risks, we may decide not to pay any attention to them, but if not paying attention to them is exactly the same as being exposed to them. So that's a choice. We choose to be exposed to these risks by ignoring them. And climate change is an example of a long run risk. Although we see a lot of evidence of climate change today, most of the fear is that this is only the beginning. It's going to get worse. We're going to have more storms and heat waves and droughts and so forth in the future than we're seeing already. And the question that's really behind all of what I'm going to talk about today is if we really think that things are going to get worse, how does that affect our behavior today? Are we seeing evidence of increasing climate risks in capital markets? Are we seeing it in our behavior one way or another? And so this is a question, are we managing this risk? Darn, I'm not. There we go. So I'd like to motivate this with an example. And this is, let's suppose for a moment that you're the owner of a luxury hotel that's right on the beach. And you know that sea level rise is ultimately going to take this hotel away. How do you manage the hotel? This is not, it's uncertain when this is going to happen, but it's pretty certain that it's going to happen. This is an example of a long run risk, obviously. So one thing you might do is try to sell it to a buyer, but the buyers are typically not fools. They can read the literature and know that sea level is rising. The main thing you might decide to do is not to renovate the hotel if the payback period for this renovation is longer than you think the life expectancy of the hotel. And so one of the key features of managing this kind of an asset would be to underinvest compared to what you would do if there were no termination, no endpoint for this. So if you reduce your investment, this is a cost. Your profits, therefore, go up. And so this actually makes your P&L look a little bit better. Secondly, if all the beachfront hotels are managed the same way, there is likely to be a reduction in supply of luxury rooms, and consequently, you might expect this supply shift to lead to higher prices for the room and therefore even more profits. So it's natural to think that this kind of a policy would be what you would do if you're trying to manage this hotel. But suppose you had investors in the hotel. They know that this hotel is ultimately going to be worth nothing. So would they remain as investors? Well, the answer is, of course, they would, because they would have cash flows coming in. And as we say in finance, the value of an asset is the present discounted value of future expected cash flows. And these cash flows are going to accrue. So there would be a value, but it would be less than if the endpoint was infinitely far away, because then, of course, you'd have the value of the asset at the end as well. Here you have no asset value. When it's over, you have what we would typically call a stranded asset from the sea level rise. As this hotel owner, you might decide to take this cash flow and do something else with it. Maybe you want to start building an electric vehicle factory, because that's a response to climate change. Would your investors be happy about that or not? Well, probably not, because they don't think you have any particular expertise in building electric vehicles, and consequently, this would probably lower your stock price. And so the most likely thing is that you're going to pay back these cash flows to your investors. And that's what they're going to expect, and that's what they're going to pay you for. Companies that supply services to this hotel would presumably continue to supply services, but they might not invest so much in their businesses either, because they can see that the business is going to decline ultimately. Insurance, you could buy insurance, but it would be prohibitively expensive, and it really doesn't really change the economics of this at all. So I don't think that insurance is an issue unless the government is foolishly willing to offer insurance at subsidized rates, which I think is one of the things that does happen. One of the things that might happen is that there could be a change in the demand for beachfront vacations. And if this demand increases, then the profits of this hotel are going to be higher and the stock prices are going to go up. So the things that are going to affect the stock prices of this hotel will be the demand and the date at which you think the hotel is going to be destroyed. But one of the things that might happen when the demand goes up is you might consider adding another wing. On the other hand, you might not either, because you don't think it's going to have a very long time horizon. So the supply of new hotel rooms is not going to be very elastic with respect to demand. So I'm going to call this risk termination risk. And we're going to use this term, it's kind of a new term, to represent all these features of this hotel. It's a long-run risk which motivates owners to underinvest, return cash flow to the investors, and has relatively small supply response when demand increases. So let's see where we can use this idea of termination risk. And this is an example of termination risk, which is due to physical risks of climate change. There are many different physical risks, however, from climate change. Wildfires, heat waves, droughts, floods, hurricanes, all these are rather inexorably increasing it. And so each of these could terminate businesses, and we might expect similar behavior from any such of these physical risks. Since I'm going to give this in Italy the day after tomorrow, here's a picture of a town in Italy which is flooded. They've had incredible heat waves this summer all across Europe. It's hurt the tourist industry. This is kind of an example of the sort of thing we're talking about. The news is full of articles like this, which talk about how severe the climate change is already, and I won't go through it all together. But the point really is that when you see how bad some of these physical risks are, it makes you want to know how to stop climate change. And the answer is actually pretty straightforward. We have to stop emitting so many greenhouse gases. And however, carrying this out is extremely hard. And because we're very highly dependent on fossil energy. And so the Paris Agreement of 2015 sort of said, we're not going to tell you how to do this, but suppose we all agree on the endpoint. That is, we all agree to get to net zero by 2050. Well, we can do it in different ways, but if we can all get to this endpoint, then we will have reduced the worst damages that we foresee. We will have limited the temperature increase to 1.5 degrees Celsius over the historical values, and maybe that will be good enough. So how do we go about achieving net zero? Well, the most common answer from an economist is the carbon tax, that you would charge businesses for emitting greenhouse gases, and this charge would reflect the marginal social cost of carbon. That is, how much damages we're doing to future generations, take the present discounted value back to today, and that is what you should pay to emit. Or and if that's what the tax is, then you can make an argument that from a cost benefit point of view, it's a good thing to do. But that's not the only solution. Another solution is to subsidize renewable energy. And this has the advantage that it increases the supply of renewable energy. It increases the technology, it improves the technology with which we generate renewable energy, and it will lead to falling demand for fossil energy as renewable energy gets cheaper and more plentiful. Another solution is to regulate emissions, and we see a lot of examples of that. California has prohibited gasoline cars. I think after 2030, they can't be sold here. They've said that you can't put in gas cooktop in your kitchen, I think, and maybe even gas heaters. I'm not sure, as of some time coming up in the future. And there are lots of different kinds of regulations that you could do. And of course, there is the last point here, which is we can cross our fingers and hope that the good intentions of the private market will be sufficient to accomplish this goal of this decarbonization and slowing down of the climate change. That, up until recently, is the primary response in the US. Europe has done a better job. There are countries around the world that are playing with carbon taxes and different mixes of these policies. So what do we think this is going to look like? Well, the International Energy Agency has recently used some models to predict how they think this transition is going to take place. And if you look at this picture, it's got coal in the dark blue, natural gas in the light blue, and this is an electricity generation. And we're at 2023, which is on the sort of the middle of the bottom axis. And what you see is that these, from a global point of view, these energy uses are increasing, but almost starting now, they're going to decrease in their model. And the model has various steps where we're going to start using hydrogen and ammonia. We're going to put in carbon capture in our power plants and do a lot of these things. And we'll get to 2050, and this is all down to zero. It's a little bit optimistic. That turnaround, I mean, I'm not so sure that turnaround doesn't look to me like this is everybody doing their little thing, or relying on the goodwill of markets. But at the same time, we need to build up the supply of renewable energy, and this is their picture for the building up the supply of renewable energy. And you see, solar is what they think is going to take the lion's share of it, then wind, other renewables, and a little bit of nuclear and so forth. Again, that looks a little optimistic. So what do we see when we look at the data? Well, here's a picture of what's happening in the world as a whole from, again, from IEA. And the good news there is that the one black curve, which goes down at the end, is coal. And you see a really precipitous drop in the use of coal energy. However, you see pretty substantial rise in both natural gas and oil products. And when you look at the green line at the bottom here, that's renewables. You see it's rising, but it doesn't look really like these pictures that we just looked at of what we need to do in the future. So, you know, there is a problem about all this. An interesting article compares the growth in EV batteries over a leading decade, and solar and wind and so forth. The annual growth rate of electric vehicle batteries was 69% a year. That's an amazing growth rate for anything. And the price of these decreased by 19% a year. If you compare that with solar, you see it isn't growing as fast, and the price is decreasing about the same. Wind is not increasing as fast, or the price is not decreasing as fast. But what can we compare these things to? Well, one thing might be to the building of aircraft for World War II. Well, that's, according to these numbers, increased at a 75% per year rate, and the price decreased at a 13% a year. That's with wartime mentality and all the things that the government can manage produced that kind of behavior, which is pretty similar to what we're seeing with electric vehicle batteries. Ford Model T was done without government aid and is impressive. Gas turbines also impressive, but are any of these things giving us confidence that this growth rate is going to be sufficient without more public policy? I don't think so. So transition risk is what we call the policies that are needed to decarbonize our economy. And the thing about transition risk is that there are winners and losers if we decarbonize the economy. And so it makes it more difficult to pass policies for this purpose than it is to do other things. So there is a view that ultimately, as the physical risks get worse and worse, we will decide we are going to have to vote carbon policies like those in the forecast there to achieve the goal of reducing climate damages. And so even if it looks unlikely that we're going to hit these targets today, we might hit them because ultimately we will have the willpower to do it and to pass maybe more draconian policies to do this. So for that reason, I think termination risk for fossil fuel producers and emitters that cannot decarbonize are facing termination risk. It may not be 100%, but if you're planning for the future of your company and you see these pictures of what's supposed to happen by 2050, there's really a chance that you're going to be out of business. And that chance may be going up over time. And so that says we can think about this as being a termination thing where the date is uncertain, but it may really be coming. So even with transition risk, there is, I mean, yes, with a transition risk where policies are involved, it's not hard to think that ultimately fossil energy is not going to be part of our lives, or not as big a part as it is today. So we should expect to see fossil energy companies underinvesting, shrinking supply, returning cash flow to investors, and shrinking the elasticity of supply. Those are all the features we saw for this hotel, and we might expect all of these to show up with fossil energy. And that's one of the things, that's what I'm going to come back to actually very soon. Okay, so what should climate investors do now? Well, one of the things that climate investors might want to do is to invest in climate hedge portfolios. And these are portfolios that will outperform when the climate risk rises above what the market expects and underperform otherwise. There might be other motivations, but let's just take this one. So in that case, you would want to invest in overweight firms that are going to do well if the climate gets bad, and underweight firms that are going to do badly if the climate gets worse. And ways to do this are to use firm characteristics such as ESG, emissions, various kinds of measures of firms, or use statistical approach, which say, okay, we would expect when there is news that the climate is getting worse, the market will punish those companies that are most exposed to climate risk. So there are many publicly traded sustainable portfolios that are trying to do this, hundreds of them. When we go to VLab, which is our website, Volatility Lab, we have a whole section on these sustainable portfolios. We follow more than 200 of these sustainable portfolios. And what do we see? Well, what we expect to see is that that stocks that are exposed to these kinds of termination or long run risks ought to be less desirable. Therefore, they ought to be cheaper. Therefore, they ought to have higher expected returns, which we call a risk premium. So you should be rewarded for owning stocks that are exposed to these kinds of premiums, these kinds of risks, and many investors do that. But if you want to hedge climate change risk, you want to be short these same stocks that have a high exposure to climate risk. And therefore, you start off with a negative risk premium in this sustainable portfolio. In fact, almost any portfolio that is risk reducing or has properties like insurance ought to have a negative risk premium. It ought to underperform the market on average. However, of course, the thing that changes is we might change our views of how serious climate change is. And if we change our views, then that is going to increase the value of these sustainable portfolios. So that's what we want to look at, whether news changes the value of a sustainable portfolio. So here is a list of the top 10. Well, no, across the top, we look at the average alpha, the CAPM alpha of all 200 of these portfolios. On a one-year horizon, the alpha is minus 9.9%. 5-year horizon, it's minus 5%. 5 years, it's 3%. Those are all negative. On average, these sustainable funds have been underperforming. Your stockbroker won't tell you that, but if you look at the data, that's what it says. That doesn't mean they're all underperforming. If you look at the ones with the highest alphas, out of this 200, there are a lot of them that have positive alphas, and these are the top 10 here. And several of them are based on emission certificates. Several of them are, and this is all online, so you can see this if you go to this website, um, and it changes every day. So we this is just a list of some of these funds. Um, we actually construct our own climate hedge portfolios uh, two different ways. One is to use stranded asset portfolio that was invented or created by Bob Litterman at Kepos, and it's basically long the S&P 500, short 70% of a coal ETF and 30% of the energy ETF. It's a totally simple portfolio, but it's actually performed extremely well. A second is a climate efficient factor mimicking portfolio, which we have done research on, and it's actually now a working paper, an SSRN. And the idea is to form a portfolio of these 200 and some portfolios. So try to figure out which ones are the best and put them into a portfolio. And so we want a dynamic, long only portfolios of publicly available climate funds. We want to minimize the variance of this portfolio and maximize its correlation with climate news after taking out standard risks. We hold the portfolio for a month and then recalculate. So all the performance is out of sample. So these two portfolios we've been using for a while at VRI. We are still developing other portfolios for both transition and physical risk, but I don't have time to talk about that. In fact, I'm running out of time anyway. Uh, so what do we do with these hedge portfolios with the two that we have? Well, one is we could invest in them directly. If you want to have that kind of performance, if you want to hedge performance, these are both investable portfolios. You could do that. Secondly, you could invest in portfolios that have a high beta on these funds, because that would say they perform fairly similarly to these hedge funds. Thirdly, you might invest in stocks that have a high beta on these funds. And these are sort of both ways of assessing the greenness of a stock or a portfolio. And a fourth thing you could do is you could use these portfolios to stress test banks. That is, how green are banks? Because the greenness of a bank has to do with its loan portfolio. And I should add on here, we can do the same thing for insurance companies. We can ask how green are the assets and liabilities of insurance companies. So you do this by regressing the stock return of each of these banks on these hedge portfolios and other factors to see how exposed the market thinks they are to these hedge portfolios. Okay, so I'm going to give you one slide about each of these uses. Here's the performance of hedge portfolios. I'm comparing first of all with the AQUI index and the spider, the S&P 500. Return, volatility, and Sharpe ratio are there over basically, well, in one case it's 15 years, in the other case it's 30 years. The stranded asset portfolio has a slightly better Sharpe ratio. Its return is a little lower and volatility is a little higher, but there's no capital need because it's a zero investment portfolio. If portfolio that you might think would be interesting would be the Spider minus XLE itself, not including the coal portfolio, and you see that actually has done considerably worse. And the climate efficient factor mimicking portfolio is the last one there, which also has a positive return and a okay Sharpe ratio. So if you wanted to invest in these over the long term, you might expect if the future looks like the past, you might expect something like this. So if you look at these other stocks, other funds that we look at, and we've looked at the return and volatility and Sharpe ratio. We've looked at the CAPM alpha, but now including on this picture also the betas on the stranded asset and the beta on the CEP portfolio, that is the factor mimicking portfolio. And I've now sorted these. Instead of sorting them by the CAPM alpha, I'm now sorting them by their beta on the factor mimicking portfolio. You get another ranking of these funds. And this is a ranking, I think of this as two different types of greenness because these are two hedge portfolios. They are not really exactly the same. And maybe you'd like a fund that's high on both of them. Maybe you think one of them better reflects what you want to do than the other one. And this is a way of sorting these publicly available portfolios to see what you want to hold. And then finally, if we go to, I think I went two. If you look at the climate section to see what happened to the betas on investment banks, we actually estimate those using a feature kind of like rolling regressions. It's what we call dynamic conditional beta. It uses time varying estimates of the volatilities and correlations to calculate a different beta on each date. And this is the time varying beta for BNP Paribas. And what you see on this slide, but you see it also in almost all the banks we look at, is this is elevated during the pandemic when we had dramatically falling use of fossil energy, much like a severe decarbonization. And this is a sort of an estimate of how sensitive the bank stocks were to that event. You see at the end, it's come back to zero, and now it's going up a little bit. We think of this as a monitor of how the bank holdings are changing over time and how sensitive the market thinks they are to financial issues. If you do this for 1,000 banks around the world and you look at the capital shortfall of each of these banks, that is how much capital they would need if we had this climate event that we're talking about, you can see it's been, well, you can't really see the bottom of the picture, but this is about 2010, I think. You can see it's really been rising. And the reason it's been rising is not so much the US, but it's much more due to China. China's capital shortfall has been rising in a very systematic way ever since 2010, and that shows up as the dominant feature in the world's climate risk exposure. So now, let me turn to the actual title of this, Capital Markets Forgotten About Sustainability. And I had to get to this picture. This is the Emperor in Star Wars who eerily says, everything is proceeding as I have foreseen. And the question is that true for sustainability and capital markets? You know, should we have foreseen what's this underperformance of sustainable funds that I just showed you? Well, when we look at them today, most sustainable funds are underperforming. I showed you that. But this is not surprising since they are underweighting fossil energy, and fossil energy has been doing very well. Why has energy done so well? Well, we've been talking about that. I think it's because it's facing termination risk, it's reducing investment, reducing supply, and the prices are going up. It's really because of the long run risk of the stranded assets. Fossil energy is not buying up drilling lands. The number of oil rigs is going down. There's a lot of evidence that the fossil energy companies are not expanding nearly as much as you might expect. And even given these high prices, their elasticity of supply is lower. So these are all features we predicted based on this analogy with the beachfront property. Um, so what evidence do we have about the energy sector? Well, one thing is to look at PE ratios, price earnings ratios. If you don't think it's going to, if earnings are high because there's a lot of demand, you might expect stock prices are high, but maybe not high reflecting increased earnings in the future, more likely only just barely high enough for decreasing earnings. So you might expect low PE ratios even though earnings are high. Similarly, you might expect book values to be overly optimistic in the value of the assets of fossil energy because they don't take account of stranded assets and they're basically based on what you bought them for, not what they're worth today. So we would expect to see low price earnings and price to book ratios. And here we have for fiscal 2020 and 2021, we've got price to book ratios. The far one on the right is energy. Here we have price earnings ratios. The one on the far right is energy. In both cases, they're the lowest. If you look, this is updated sort of regularly, but this is pictures from March. In 2023, you see energy has the lowest price earnings ratio. And even though earnings have increased very rapidly across the first row, 41% a year over the last 5 years, the prediction is that they will only increase 9% a year over the next 5 years. So it's in the investors in energy see this termination risk as an important feature that they're valuing. Countries even have this property. Countries that are heavily dependent on fossil energy face termination risk of their leading sectors. If you think about the Middle East, from Saudi Arabia, Abu Dhabi, and the Emirates and so forth, they are all they're getting lots of cash flow, they're restricting output as part of OPEC, and they're trying to diversify their economies. What about Russia? Well, Russia has reduced its energy supply. It's part of the invasion of Ukraine. The supply reductions are partly from sanctions, but partly put on by Russia by itself. It's reduced its supply of natural gas to Europe. It thought it would freeze Europe, but Europe managed to survive the winter. It's the price of energy has gone up dramatically. Russia is making a lot of money. The ruble has gone back up in value. Why did Putin wage this war? Well, I think he saw that in 10 years, his economy is not going to be as strong. It's going to be reduced demand for energy, and Europe is going to be more energy self-sufficient than so he had to do it now. He was going to do it. So I think Putin even believes in climate change and is acting as if he believes in it anyway. So should we be disappointed about what's happening with these high prices of fossil energy? Is that a disaster for climate change? Well, not necessarily, because high energy prices, high fossil energy prices have always been a part of decarbonization. We expect if we want to have a good allocation of resources, we expect people to choose to buy less emitting goods rather than high emitting goods. And this is a way of encouraging people to switch from gas cars to electric vehicles, to put more insulation in their house, put solar panels on the roof. All those things are what consumers might do because the cost of oil is so high. It's now been it's close to $100 a barrel. That's very high. It also encourages intermediaries to use less oil and try to find substitutes or be more efficient about the oil that they use. High energy prices are hard on many people, but they are good for uh, decarbonization. Um, they will encourage investment in renewable energy because that will be super profitable at these high energy prices. But high energy prices also encourage fossil energy to expand. But because it's facing termination risk, it doesn't expand so much. And you can see evidence of that. The Wall Street Journal had an article last week talking about how the frackers say the key word for this episode is discipline. They're not going to jump ahead and expand supply the way they used to. You see today in the Wall Street Journal that Exxon is buying or trying to buy Pioneer, which is a big fracker. Well, that doesn't actually increase supply. And this is Pioneer getting out of the business. So this is the termination point of Pioneer. We don't really know what that price is compared to really what it used to be or what it could be. But maybe this is a low price and Exxon is just doing like investors do. They're buying the cash flow for a few years. So I'm not sure. I mean, the paper writes it like this is a big expansion of energy supply, but it's not clear to me that that's what we're seeing. So, what would be different if we had a carbon tax? We don't have one. We could have had one, but we really don't. Well, in that case, you would still expect to see the reduction in supply. You'd still expect to see higher prices, but you wouldn't expect the stock market to go up so much. And so the revenue would be going not to the investors, but more to the government. Government could reduce other taxes. That would be a way of making the climate justice a little better. Uh, and it would have also meant that our sustainable funds would do better because they're underweighting the energy companies, and it's the energy companies' profits that are making the sustainable funds do badly. Um, what's the future performance of hedge portfolios? Well, in a net zero world, these are ultimately going to go to zero. We may or may not be in a net zero world, but at least that's a prospect. But from a hedge portfolio point of view, you still would want to short or underweight energy companies, I think, because if the termination date gets extended outward, then that means climate is not as serious an issue, and then the stock price goes up. So, but if the termination date gets brought in further, then the stock price is going to go down, and that favors your portfolio. So it would continue to have this this hedge characteristic. So I think Putin has accelerated our decarbonization. It's really happening much faster than it would if he hadn't invaded Ukraine. I think the Biden bill has accelerated our decarbonization by subsidizing renewables in a very dramatic way. And so has the EU New Deal, Green Deal, which is again providing lots of subsidies for decarbonization. And hopefully these things will actually lead us in a climate-friendly direction. So here are my 3 of my 5 grandsons looking out at the future, and they're pretty worried about what we're doing for them. But if we can tell them that we've got it solved, they'll be a lot happier. Thank you.
Thank you so much for that. Remind everybody, we will have those slides posted later today. So if you want to look up any of the funds or companies he was mentioning, as well as the YouTube video, hopefully by the end of today, we'll see how that goes. We have time for just a few questions. If you would wait until Jay gets to you with the microphone and speak up. And Rob, I'll let you call on people, but
Okay.
we're going to end at 9. So
Great. Okay.
Thanks, my tradition is. So if I were to talk about not excellent Ford Motor, and I'm an investor in Ford Motor, and this is sort of uh, the argument about, if I'm Silicon Valley Bank, I always have to find investing in real estate, the floods that I might have federal government flood insurance. But if I'm investing in Ford Motor Company, uh, my business is going away, Trump combustion engine vehicles. But private investors are not paying for a lot of the transition to the EV model. So in a sense, I'm getting bailed out as a Ford Motor Company investor by the government in this transition. Curious process.
Well, I think that, I mean, one of the sort of complications of trying to identify stocks as green or brown is that many of them are both. And I think that's what you're talking about. And so if you start divesting yourself of fossil energy companies and maybe car companies, then they have a dilemma of how do they avoid the high cost of capital that you're putting on them. And one answer is that when they do the EVs, they might do it as a spinoff. And I think you see a lot of that from energy companies. We're not seeing it in the car companies, although we could. I mean, Ford could spin off its EV enterprise, and probably it would be viewed as very valuable, and then the rest of the Ford stock would go down. So you would from a theoretical perspective anyway, that might be good for the market, the whole thing. So you're asking specifically about the subsidies. So if the subsidies are going to the EV part of Ford Motor Company, then they're also subsidizing the combustion part of Ford Motor Company. But they're going to subsidize the transition at Ford. I mean, if you get a rebate when you sell an EV Ford compared to a combustion Ford, that relative price is going to move the behavior of Ford Motor Company too.
Rob.
Okay. Who's got a microphone? You have a microphone. Okay. Do you want to bring it over here then?
So, Rob, we're sitting less than a mile from the world headquarters of General Atomics, which is one of the great nuclear research companies in the world. May have the promise to change much of your slides, and they are connected with Lawrence Livermore and the Fusion Project, right? And some other things. Do you have any comments on that?
I'd love to see fusion come online. We all would. When I was a teenager, I read a book called The Sherwood Project, which was about research at Princeton to do fusion. It's been coming for, 50, 60, 70 years, and it isn't here yet. I think, there are lots of things that are promising, but pretty far from reality. I think we should invest in them. Investors should invest in them. People invested in Tesla before it was apparent that it was going to be such a big success. So I would expect people to invest in it, and they're doing it. At least my reading is that people are buying up companies that have a plan for how to do fusion, how to do green hydrogen more efficiently, how to do all these kinds of things. That's what the subsidies are going to do for us. They're going to channel capital into the technologies which turn out to be the best, and hopefully will reduce the pain of those giant declines that are being predicted or required. Okay, next. Yes.
There's this old notion that the reserves of oil might cause the price of oil to actually fall, as it seems apparent that we're leaving gasoline.
Right.
Is there a sense that, particularly in Middle Eastern countries, is there a sense that the termination risk is likely to be faced with oil in the ground? Or is there a sense that an oil price fall is still inevitable as we get closer to that termination of reserves?
Well, I think I mean, there's this old quip that the Stone Age didn't end because we ran out of stones, and I don't think the oil age is going to end because we ran out of oil. I mean, we used to worry about peak oil, but now peak oil has a different meaning. It's when do we stop investing as much into oil so that we convert to renewables. So I think there's still going to be lots of oil in the ground, and there's going to be the price is going to be so low that it is a classic stranded asset. It doesn't pay to pull it out.
Okay, I know some more of you have some great questions, but I've tried to keep Rob's tradition going all this time that we end when we say we'll end, and I hope you'll stay around for a couple minutes.
Sure, I can stick around.
And I hope to see you all back February 9th. Frank Well.
Thank you.
Great job.
Well, can I